everyone. Welcome to episode 44 of Takeaways. My name is Patrick Searcy. I'm the Director of Marketing for ALN Apartment Data, and I'm joined by the actual star of the show here, Jordan Brooks. Jordan is our Senior Market Analyst. How are you, sir?
I'm great, Patrick. How are you?
I'm doing very well. Thank you so much for asking. Before we get into it today, I just wanted to give a quick reminder that really helps the channel out. If you could give this video a like, subscribe, and click the notification bell so that you don't miss any brand new content coming your way from YouTube at least. But today we are talking about the March 2024 newsletter article. It's called Positive Rent Growth in a Majority of Markets. So Jordan, you talked a lot about the interplay between new supply, average occupancy, and their effect on rent growth. But you also mentioned apartment demand a couple of times, but to a lesser degree. Did anything really stand out in the absorption data relative to recent rent performance?
A few things. For one, some of the primary Sunbelt markets continue to struggle a little bit on the demand front. Once you adjust for size, so a metric that we like to look at is absorbed units as a percent of existing stock, just to kind of adjust for market size. Once you look at that stat, a lot of the secondary and tertiary markets, many of them in the Sunbelt, look really, really positive. So markets like Abilene, Huntsville, Augusta, Chattanooga, a couple of the secondary markets in Florida, Fort Myers, Naples, Gainesville, areas like that, all look quite good from the perspective of that sort of size adjusted metric. And then, some highlights amongst the primary markets, two in particular I would point to would be New York and Miami. Those two areas, even on the size adjusted percentage basis, were showing up near the top of the list, which normally you're going to get mostly small markets in that metric. So on a sort of pound for pound basis, as well as just the number of units absorbed, those two markets in particular have looked really good over the last couple of months. And then LA, Philadelphia, and Seattle, others that are primary markets near the top of the list in terms of net absorbed units. LA and Philadelphia in particular have been, more hit or miss over the last few years. So, good to see those near the top of the list.
What should we be paying attention to aside from new supply pressure as a potential risk factor for rent growth this year?
A couple of things. I think one is, there are markets where new supply is slowing a little bit this year, but they've been really active over the last few years. And so the new supply won't be as much of a factor this year, but the lower occupancy that's the result of active pipelines over the last few years will be an issue. But aside from that, one thing is just, presidential election years, economic growth tends to slow. And so it remains to be seen kind of what that effect from the broader economy will be on multifamily. Another is just, the general affordability situation and the sort of financial position of households. We've had a lot of rent growth, not so much last year, but the previous few years, a lot of inflation over the last few years. Household savings rates are down, credit card usage is up, debt balances in general are up. And that comes at a time, obviously, with higher interest rates. So those debt payments are also up. So that doesn't leave a ton of running room for rent growth. So that's something to watch. And then related to that would be the labor market. So, the labor market has remained tight. That's sort of a double-edged sword. It feeds into inflation, which is the downside, but also tight labor market means people are generally employed. Wage growth is generally positive. We did see wage growth outpace inflation last year. So the tight labor market is kind of keeping the wheels on when we talk about, savings rates going down and debt levels going up. If we see softening in the labor market, that would be something that is sort of a downside risk for rent growth. So, I would say aside from new supply in multifamily, which is going to be a main driver, just sort of some factors from the broader economy are worth watching.
Well, let's talk about upcoming events. I'm sure you've got quite the plate full here coming up. So where can we see you?
So March 26th, I'll be doing a webinar for the Myrtle Beach Apartment Association. April 10th, I'll be doing a webinar for the Arizona Multi-Housing Association. April 11th, ALN and Resman will be co-hosting a webinar that I'll be on. So again, that's April 11th. And then April 24th, I'll be speaking in person at the Virginia, the VAMA conference. And then April 25th, the very next day, I'll be speaking in person in San Antonio at TAA. And then lastly, I'll be doing an in-person presentation April 30th for the Houston Apartment Association. So all those
So not much, right?
Yeah, yeah. It's not going to be busy over the next 6 weeks or so. But yeah, so all those events will have details across our social media, particularly for the webinars. All those registrations are still open and available.
Yeah, and meanwhile, do keep an eye on our blog at alndata.com/blog for more of our original content and more articles that you can find there. And Jordan mentioned it, but do keep an eye also on our social media. You can find us on X at ALN APT Data, or just search for ALN Apartment Data on Instagram, Facebook, and LinkedIn. Don't forget, again, to like and subscribe to our channel. It helps us grow. And Jordan, we'll talk with you next month.
See you next month. Thanks.